People are rolling in as they grab their lunch, and I'm just going to give a quick update so that we can start promptly. I know Janice has a lot to talk about because these are pretty hot topics, and there has been quite a few changes since we last got together with her that she'll have to address for us. So quick updates from AHA and Amplify. Our next event is live and in person. It's a networking event. We're really excited to be partnering with Good Lawyer, Alberta IoT, and ATB, and we're doing an event on fractional executives and how they can help your business. So that's a live event on Groundhog Day, February 2nd. We are very close to being sold out. So don't hesitate if you're interested in some CPD, some networking, and learning about how you can grow your business with fractional executives. This particular event is definitely designed for business owners and business leaders of growth businesses. And we're really excited to have great partners and a great opportunity to do live events. We are doing the third Tuesday of February, as we do every month, except July, August, and December. And this coming month in February, we're doing cybersecurity. So cybersecurity is one of the only events that we put on for AHA that is mandatory for our people to attend. Obviously, there'd be a ton of our amplifiers on this call here to listen to Janice, but we don't make any other session mandatory besides cybersecurity. And the reason for that is because cybersecurity is a trend of risk and cost that we really need to be ahead of. And the thing about cyber is that the biggest risk, no matter what size of company you're in, is the humans that you have permitted to access through cyber, your systems and your information and your data. And so with humans being the biggest risk, what's the best way to mitigate that risk? It's certainly training. And so come join us third Tuesday of February, and you will get a chance to do some training, which will certainly help with your risk of human error, which is absolutely the most likely way that you're going to find yourself in a situation of a cyber attack. Very excited to put a twist on cybersecurity. It'll be the third year we do it as a topic. And this year, my husband's actually going to be doing it. So I did a little bit of twisting his arm and told him that we should give working together a chance. Pretty sure it will be the one and only time that him and I ever work together. So if you want to witness that, in addition to learning about cyber, this is your chance. Unlike Janice and so many of you, I've never worked in the same institution or organization as my husband. I never met him that way. And so this will be an exciting little twist to keep cyber exciting. But we are going to touch on some really good topics for that session. In March and April, registration is not open yet, but we are thrilled to let you know that we're going to do a tax update in March. It is going to be designed for business owners and business leaders. We're going to be talking about estate and tax planning and setting up your business. And in April, we're going to be looking at insurance. And I know that all of you as CPAs and business leaders are the buyers of insurance. And in today's market, especially with the changing in prices and oh my gosh, the changing in insurance prices, you're all going to be looking at your policies and making sure that the cost benefit is right for the risks in your organization. So it's going to be a timely and important conversation in April on insurance. So the third Tuesday of every month besides July and August and December, you can join us for lunch like you are today to get a CPD certificate and get an opportunity to hear from amazing experts on topics that matter to CPAs and business leaders. And now that the world's opened up, we do also have live networking events in addition and on top of the third Tuesday webinar. So without further ado, really excited that Janice has joined us for the third time, I think. And every time we have Janice, she somehow makes a topic that can be a little bit challenging, exciting and engaging. And so that is a special skill set that you can't find from the big four firms and you can't find anywhere else. But we at Amplify are so excited that we are able to provide it to you because Janice is always a great friend and great supporter of you, our community of business leaders and CPAs and of us at Amplify. And we couldn't be more grateful to have her here. And she has so much to talk about that I will stop blabbering and we'll let her go.
Let me do my thing. So hi guys, and thanks for sharing your lunch hour with me to get these much needed CPD credits in. Really hope that this is going to be an informative session, technical accounting on IFRS, and also the new frontier, which is the financial reporting of ESG. So please feel free to ask questions along the way, I think through the chat. I'm going to do my best to answer them. As Jamie said, this is my third year presenting with Amplify, and I really appreciate being asked to speak back. You know, it's kind of my little passion to do speaking on technical accounting things. So Jamie, thanks again for this opportunity. Let's try to make this as interactive as we can over this technology platform. And I will take pauses along the way for questions. So who am I? I think probably some of you know me from either past Amplify events or through Jamie's PwC network. I started off my career at PwC though, just spending over 11 years there. And the last couple of years there, I was a senior manager in the technical accounting practice, where I really refined that skill set. And I also had two very large public oil and gas clients that I did in my volunteer time at PwC. So I left PwC to pursue a more specialized career in technical accounting. I joined the Office of the Chief Accountant at the Alberta Securities Commission. So one of the major projects I worked on while I was there was the non-GAAP securities law. That was Rule 52.112. That was enacted last year for those public companies. I'm sorry, it's a pretty complex rule. All I can say is that IFRS is fairly difficult to create a securities law around, but hopefully those challenges have kind of subsided after a year of implementation. So I was the former interim chief accountant and CFO, and then I left to join Nutrien as their director of technical accounting. But this year I have also changed roles quite recently, in fact. So I am in the newly formed role that was created in response to the proposed mandatory securities regulations that we're going to speak about today. And my role is to create a team and be ready to implement all of these mandatory reporting that is going to be coming quite soon. So we're going to talk about ESG on the back half of this presentation. Besides some of this technical work, as Jamie alluded to, I'm happily married. Some of you guys know my husband. He is also an accountant. But these are two wonderful children, which keep us very busy. We finally got to travel this year. So this was past pictures of us being in Maui. And for some of you also know I do Spartan races, done 7 trifectas. So we do have some fun in our free time. So here's the agenda for today. I'm going to go through the IFRS amendments, some IFRS decisions, explain what those mean. I'm also going to go through the IFRS discussion group topics. Actually, that reminds me, I did become a member of Canada's IFRS discussion group in 2022, which was a super technical, nerdy thing that I'm really proud of. But I will give a shout out to the IFRS discussion group. This is the group that discusses technical topics in Canada related to IFRS and securities regulation. We meet 3 times a year and stream these meetings live. So you can actually listen to us members discuss Canada's most relevant IFRS issues in real time. But there is also meeting reports that are published. So you can search for past issues on the Canadian Accounting Standards Board's website. I did place a link at the end of this presentation, or really just Google IFRS discussion group and you'll be able to search past IFRS discussions online. So I find that a pretty good technical accounting resource when you're trying to look for topics of interest. I'd like to point out the caveat on this slide that Jamie has nicely put into my presentation. I want to remind everyone that information contained herein is not a substitute for competent professional advice. Well, I think I'm a competent professional. Other people might think otherwise. So I'm just here to deliver some accounting information to what's new and novel, perhaps add my snarky remarks to keep you engaged in this presentation. I'm not getting paid. I do this for fun. So if you do have questions outside of this presentation, do please follow up with your professional advisors. This is going to be long. It's an hour and a half, guys. You need to get those CPD credits. So try to stay with me and try to stay engaged, and I'll try to make it as fun as humanly possible for technical accounting. So let's get into it for what is new for 2022, i.e. what should you have already been doing? So great news. There's no new standards for 2022. I mean, it's really too late to be finding about that now. Like it's January 2023. So if you're like, oh, I didn't know it was there, you probably should have been aware. So that's great. There's actually only a couple small things to be aware of from an amendment to standards perspective. So I'm going to touch on these 4 amendments on my next slides. There's also IFRS also issues these periodic annual improvements They're published to make very, very small amendments to standards, almost like nits of the standards that don't really need to talk about it a lot. But I do have the 3 on the slide. IFRS 9 was amended slightly to help address which fees are included in the 10% derecognition test. So if you're doing a debt modification or you're looking at whether you have a liability that's derecognized, you probably have to apply the 10% test to really assess whether you have derecognized or treat it as modification. So I actually found that modification helpful because it does tell you which fees are included or excluded. IFRS 16 was amended just for a minor illustrative example on payments from a lessor related to leasehold improvements, not that exciting. And IS 41, which I guarantee nobody on the phone, unless you're a cannabis company, is using, they amended that standard to remove a weird tax issue in measuring fair value. So again, nothing too significant there that you should be aware of. There was a couple IFRIC agenda decisions. So IFRIC is that is the IFRS Interpretations Committee. So that international group runs out of London. They're the only authoritative body that can actually interpret IFRS. So you have the International Accounting Standards Board that sets accounting standards, and then you have the IFRIC, and that's the only authoritative body that can actually interpret those standards to give you more information. So, and an interesting fact, we have 2 Canadian members who sit on the IFRIC. We have Guy Jones from E&Y and recently appointed Karen Higgins from Deloitte. So it's really great to see some Canadian representation there. And actually, I will just shout out for standard setting for the international board. Canada's former chair of the Accounting Standards Board, Linda Maison-Hunter, she just got appointed to the IASB. So I think she's going to be an excellent asset to helping set Canadian views on the international playing field. And Linda just got appointed vice chair. So really kind of quick to make it her way through the board, but something I think we should all really be grateful and look forward to because we'll really have our Canadian voice on the international playing field. So IFRIC gets a lot of questions about how to interpret IFRS, and what they do is they then issue agenda decisions. And so there's a couple out there. I put the whole list of the 2022 agenda decisions in the attachment in the back of the appendix, which I presume Jamie will mail out afterwards. Those are good to scan through. I put the titles in there to maybe it might jog, oh, I should look into that. That's something that may affect me. The only one that I think is really relevant to the majority of Canadian IFRS preparers is this decision on cash received via electronic transfer as a settlement of a financial asset. It's a very long title. I'm going to go through that one in detail because it might question your existence and how to do a bank reconciliation. So without further ado, get into more detail. So in terms of the amendments to standards for 2022, there are 4. The first two are on the slide. The first one is a small narrow scope amendment on the business combination standard. Really what this is getting at is just to clarify the requirement for booking provisions when you're doing a business combination. It really just says that when you're looking at a provision and whether you record that liability as part of your purchase price allocation, look to the guidance in IS 37, the provision standard, and really make sure that a present obligation exists as a result of past events. So I don't really see this being a novel change to the business combination standard, but there you go. More interesting is the amendment to IAS 16, PP&E. I also think it's interesting as IFRS 6, the E&E standard was not amended. So this amendment might create a change for extractive activities, oil and gas and mining. And it's going to depend on what your current policy is. So at Nutrien, we had to take a look at our mining operations and see whether this impacted us, and it did not. But there was a policy choice. So previously, if you were in the testing phase of an asset, it's not ready for use yet, but when you're testing it, you might generate some product, oil, extract some ore that you can sell. Well, what do you do with those proceeds? Kind of that question. Do you capitalize it as an offset to PP&E and reduce the amount of PP&E on your balance sheet, or do you get to recognize that credit in the P&L as revenue? So now this amendment has been issued and it prohibits the second choice. You can know, oh, sorry, I said that in the wrong way. Let's just say it this way. You have to recognize it through P&L in revenue. So you can no longer offset amounts earned in the testing phase as an offset to PP&E. It all has to go through the P&L. So if I recall my auditing days, I did have a couple of clients that use this as a policy choice. So perhaps it might move a dial. But yes, so on a go-forward basis, and I believe this one was retrospective, you might want to consider it if you had a policy choice to offset PP&E. Okay, IS 37 is the next amendment on our list of 2022 things that you should be doing. So the ISB decided to amend the guidance in respect to onerous contracts. So those are the contracts that you have signed, entered into, and are no longer going to be profitable. But the question is always, okay, well, how do I determine that my contract is no longer profitable? Here's the expected revenue, but here's the expected cost that I should consider. And obviously, if its costs are higher than revenue, it's onerous. And then the standard would say, recognize a provision today, even though it might not be onerous, or you might lose money next year. You would have to recognize that provision up front. But it's kind of confusing, like, well, what cost should I recognize? Is it just the direct cost of fulfilling my contract, so direct labor and material, or should I be allocating costs, indirect costs related to completing that contract? The IS 37 narrow scope amendment clarified that and said you should use direct and indirect costs. So for example, an allocation of depreciation charge for an item of PP&E used in fulfilling that contract. That doesn't sound hard to calculate and conclude, but you have to now. So really, when you're considering your contracts and whether they're close to onerous or not, really take a look at this narrow scope amendment, as I think there's some examples in it. That one, again, started January 1st, 2022, but it's applied prospectively. So only look at your contracts this year that might be onerous. And the last amendment we talked about last year, for those of you who are with me, this IFRS 16 COVID rent concessions. So what happened was in 2020 at the pandemic, there were a lot of companies getting rent concessions on their leases. And the question was raised, well, under IFRS 16, do you have to do this complex lease modification accounting? So the ISB said, well, that sounds hard. Wasn't really meant to, like, for all of these leases during COVID. It's kind of a particular case to kind of go through and look at whether you have actual true modification accounting, which is annoying and complex to do. So the modification essentially said that, hey, if you get a rent-free period or reduced period for COVID, just offset it against the P&L. Make it simple. That amendment was then extended to June 30th, 2021. And then that amendment was expanded to rent concessions received up until June 30th, 2022, which is why we're still talking about it in 2022. It was not extended this year, so maybe this is accounting's subtle way of saying the pandemic is over. So let's get to this interesting IFRC agenda decision that I alluded to. So the IFRC was asked a fairly straightforward question, and it's how to interpret current accounting standards. So what was interesting about this question was the committee was asked when to derecognize a trade receivable when it is settled by a customer via electronic fund transfer, EFT. So the example was that a company has a customer and it may call them up and say, I'm going to settle this receivable with an EFT. The company initiates that EFT, and then 3 days later, it gets received by the company into the company's bank account. When should you derecognize the receivable? Well, it kind of seems straightforward enough. As a company that I have a receivable, if I did not physically receive cash in the bank, I should not derecognize my receivable until I got cash. Because generally, how are we going to know that we're going to get the cash for our receivables? You look at your bank statements, you're like, great, I got cash. Derecognize the receivable, book a journal entry. So it really seems straightforward enough. And that's what appeared on surface of this IFRC agenda decision. So in this example on the slide, our entity, the customer has initiated the electronic transfer on December 31st. On January 2nd, get it in the bank account. So the IFRC said that, well, when you have a legal right to that cash, then you should book the journal entry. So you book debit cash, credit receivable. So unfortunately, this led to broader questions by us technical accounting folks and said, well, what happens if the holder receives a check, instead of receiving cash through an EFT? You know, when should that entry be booked? Is it when the check clears or when the customer can access cash? In practice, such distinctions are not usually made. So that was the start of this IFRIC agenda decisions being a bit unclear, but ultimately the IFRIC said, well, when you think you have a legal right to settle the receivable and you receive the cash, that's probably when you book the journal entry. But the converse question is the more complicated issue. And that's the problem with trade payables. And the question was then raised, when should a trade payable be recognized? Is this something you've thought about lately? So I think in practice, you have a payable, you decide to pay it, you initiate a transaction with the bank to pay it, or you write a check. When do you derecognize a trade receivable? So I can now speak for Nutrien, as I had to investigate this process. So effectively, we initiate repayment, we derecognize the payable, and simultaneously derecognize the cash. However, there is a period of time in which we initiate the payment and it hasn't left our bank account. So we do actually go through a process at the end of each month end, quarter end, annual report and said, hey, do we have any of these and are still left in our clearing account that have not physically left our bank? And we reverse that entry and book a topside entry to re-recognize that payable and re-recognize cash, because cash has not left the building. We still have control of that cash. So the cash is still ours and the payable still exists. But if we think about the IFRIC agenda decision, technically applying that to the other side, it kind of goes towards the concept of IFRS 9 and the ability towards derecognizing a financial liability. So IFRS 9 would say you cannot derecognize a financial liability when and only when that obligation is discharged, canceled, or expired. So in practice, while the system usually derecognizes it earlier than the payer is actually receiving the cash, and that's when the legal liability disappears. So effectively what's being implied is that only when the customer receives the cash in their bank account is when the trade receivable is legally settled. And the legality behind it is when the trade payable should be derecognized. So, but when as a company, do you actually have any sort of insight when your supplier receives the cash in the bank? I mean, once it leaves your bank, you have no clue. And as the bank withdraws the cash from your bank account, as soon as it initiates the EFT, cash needs to be derecognized. That side of the entry is obvious. But if you still have this payable because your customer has not received the cash, do you have an offsetting receivable for the bank? Can you offset that? There's just so many questions that were raised with this IFRIC agenda decision, and it became quite problematic because this goes towards the whole system of bank reconciliation, and I don't know, counting for the last 50 years. 50, 100? How long have we been doing this? Okay, so what happened? The IFRIC did issue a tentative agenda decision on this. They were asked a specific question on receivables. They answered the specific question on receivables. Their job is done. However, tentative agenda decisions need to be approved by the international board before they become binding as agenda decisions and effectively become mandatory. Based on the comment letters that were received on this tentative agenda decision, I think everyone started to realize that this could snowball into a big issue. And we would actually be having a conversation now that says, hey guys, you now need to go for your year end, call up all your suppliers, ask them if they received the cash to get your cash and payables correct at December 31st, which sounds ridiculous. So what actually happened in that meeting was the IASB did not approve the agenda decision. So it's not final. We do not have to do anything yet. And they've instructed their staff to perform additional work, which hopefully will be done on the next year or two on this topic to solve it once and for all. When do you derecognize trade payable? So my observation and observations by the firms are saying this may be a disclosure of an accounting policy choice because it's unclear on the accounting for December 22 year ends if this is a material issue. So it is something to look at. Hopefully it's not a material issue, and do stay tuned on this one. So I'm not going to lie, I thought this was riveting stuff. I mean, my team at Nutrien, we actually streamlined the webcast for the IASB meeting, because we're like, we do not want this additional work at the end of the year to figure this out. So luckily the IASB, in my view, made the right decision to put a halt on this and leave it to be an accounting policy choice. So effectively we do nothing and we wait and see for future amendments. Okay, that's it for 2022. What is new for 2023, i.e. what we should have adopted 17 days ago? Okay, also good news on this front is we don't have a ton of new issues. This is probably remnants from COVID and kind of the pause on standard setting that we saw for the last 2 or 3 years. And also I think as the international board is setting up the sustainability standards body, the ISSB. So I think we've kind of seen a bit of a moratorium on standards, but don't you worry, there are a lot more to come. But what's new for 2023? So the first one, I'm going to take you actually through all 4 of these ones separately. So let's not talk about this slide any longer. First one, IFRS 17. What is IFRS 17, you may say? This replaces IFRS 4. And this is if you're an insurance entity or an insurance company, you would have been previously applying IFRS 4 to account for insurance. But then the IASB decided, hey, you know, I don't really like how people are accounting for insurance under IFRS 4. It's been 20 years in the making. Let's change the insurance standard. So we'll talk more about IFRS 17 because it's a little bit of a sleeper issue because it no longer just applies to insurance companies. So it might be something that your auditor may ask you questions about. So I'll try to give you a bit more knowledge about how to answer those questions. There was also an amendment to IAS 1. And this is a slight tweak. Where am I in my slides notes? This is about your accounting policy disclosure in your financial statements. And what the IASB is trying to do is say, look, guys, don't just have boilerplate accounting policies if those are not material to your financial statements. So really only disclose material accounting policies, not just what you think are significant. So originally I thought, you know, I was going to tell you guys, like, don't really worry about this one, not that exciting. We're already going through our year end at Nutrien. We're starting to see kind of the impact on this because we're already getting questions like, do you need that accounting policy? Is it material to your users? Perhaps if it's not material, you might want to start to take it out just to start reducing your financial statements. If it's not material, take it out. Don't bother. So anyways, just a shout out to make our financial statements more relevant and less boilerplate. Also, what is new for 2023? There's been an amendment to IAS 8. So that's our definition of accounting policies versus estimates. We like changes in accounting estimates because that's prospective. We don't like changes to accounting policies because that's retrospective. There's been a slight tweak to the definition. I haven't spent a lot of time on this one, mainly because I'm working on ESG now, but I just want to put a shout out that there might be something here. Heard inklings, maybe ARO. There's some estimates that you might want to consider even further. But it really just explains how companies should distinguish changes from accounting policies from changes in accounting estimates. And last but not least is the bigger one of the 2023, and that's going to be the amendment to IAS 12. And so I think before IAS 12 was amended for this, there was a little uncertainty as to how to do the initial recognition exemption for deferred taxes, specifically when deferred taxes don't apply to transactions such as leases and decommissioning obligations, where you're setting up both an asset and a liability, and how do you do the deferred taxes on that piece. I think majority of Canadian companies have already set up the deferred tax piece on both provisions and ARO, so it shouldn't make a difference. But if that's flagging something in your head, go look at the amendments for IAS 12 or talk to your tax advisor. Okay, so again, I wanted to spend a little bit more time on IFRS 17. I don't love it, probably don't understand it as much as I should, but I'm just going to bring this up. So IFRS 4 really it was very clear that it only applied to insurance entities. I've never audited insurance, so I've never really cared. And really what the ISB thought there, they found that using IFRS 4 insurers of different companies or countries and different industries were applying insurance contracts differently. So you need a new model to fix it. This project was started back in April 2004 and culminated in a final insurance standard in 2017 that is only effective January 1st, 2023. It's pretty complex for insurance and banking companies to adopt, so they kept delaying the effective date. It also ties in a little bit with IFRS 9 and how to do financial instruments. So some of the synergies, crossovers had to be sorted out. So anyways, it's here, it's now, it was effective 17 days ago. Why should you care? So IFRS 17 applies to insurance contracts, regardless of the entity issuing them. Like, oh, shucks. So it just really appears like to more widely contracts than before. IFRS 17 defines an insurance contract really based on whether a contract transfers significant risk. And although that definition is similar to IFRS 4, many entities were previously able to unbundle insurance elements and apply different measurement standards, whereas IFRS 17 applies to the whole contract with limited exemptions and has very detailed measurements. So insurance risk is considered significant if in only one scenario that has commercial substance where an insurer could possibly suffer a loss on a present value basis and pay significantly more additional amounts beyond which have been paid had the insured event not occurred. A lot of words. Effectively, really take a look at if you have some insurance contract or what you think are insurance contracts. The best way I can give you is just an example. So listed on the slide, A through E are some arrangements that likely may be covered in insurance contracts. So those are warranties that if you're issuing a warranty on products and services that you don't actually sell, that's an insurance risk. If you have performance bonds that you're issuing, there might be insurance risks. If you're issuing an indemnity issued by a vendor on the sale of a business, that even might be covered under insurance risk, or guaranteed minimum profit, or contracts that guarantee a minimum level of output. So please take a look at this. I think the best advice I can give you on this, if you're concerned that you may have insurance contracts, PwC issued a publication in February 2021. I think it was like Spotlight on IFRS 17 for non-insurance companies. Google that one, it has some great examples. This was also discussed at the IDG. I think that was in the May 2022 meeting that we had. And that really has some great thoughtful advice, and it was a good discussion by IDG. So please take a look at it, and you might need to write up a quick paper as to how IFRS 17 applies. Okay, that's it for 2023. I'm going to take a drink of water. You guys can digest that. Jamie, do we have questions?
Not yet from the group. So if people have questions, make sure you let us know. And I did have one quick question on IFRS 7. I think I understand what you were saying, but one question I had is if you're a buyer of insurance, which everybody would be, is there anything you have to look at, or no. Is it very much provider?
Yeah, that is on my slide directly. IFRS 16 is the issuer of contracts, not the buyer. Great question. Missed that point.
How I read it, but just because we're all on the other side, I wanted to make sure.
Not buying insurance contracts, you're fine. You just expense, do the normal prepaid expense insurance, not that fun. Spend more time negotiating on your insurance premiums. No, this is if you think you're issuing an insurance contract. I know we're looking into it, and I don't think we have any, but again, it's just an annoying exercise to go through.
Yeah, especially because there's no question that A through E that you've got there, you wouldn't call them insurance contracts in your operational business. So it'll be like pulling teeth, trying to get the information you need. As
it is. Let me tell you that one. We've sent some checklists out to our business units, being like, do you do this? Like, is anything?
Yeah, you'd almost be better off like not using the word insurance, because they'll go on a total different roadmap, right? One question on the trade payable, that one's super interesting. What's the recommendation? And I assume that a lot of people are sending in letters. Like where do we anticipate that's actually going to go?
Okay, so yeah, the letters were on the slide. The letters were on the tentative agenda decision, so that's done and dusted. Right now, we're going to be monitoring amendments to IFRS 9. So where you're going to see this come out is the IASB is doing what we call a post-implementation review of IFRS 9. And they have targeted that as a specific question. So I think when we start to see amendments to IFRS 9, they will put some resolution on this. So we're just going to have to keep monitoring for IFRS 9 projects to settle the electronic transfer. My best advice right now is to actually go through your systems and like, what do you do? How do you recognize your payables? Like, I think it's good for all of us at the executive level, above, not executive, middle management and above level, and to say, like, let's understand when we derecognize trade payables. What is our process? Because we had to do that for all of our different countries and legal entities and say, okay, when do we do it so that we can understand IFRS 9 amendments when they come out? So when do you derecognize? Do you derecognize when the system initiates a transaction through an EFT or when it leaves the bank account? Are you aligned internally? Is this for every country or every operation that you do? We found, one of our entities didn't do it and we were like, oh, we should correct that. That's not material. But things that we had to look at and actually ask the good question, like, do you have a handle on when you derecognize payables? I am very hopeful that the IASB will not conclude we need to derecognize trade payable when the supplier gets the cash, because our systems in Canada, US are not set up to understand that. Like, then we would have to change our supplier contracts to say that, okay, well, the supplier agrees that when electronic fund transfer has been initiated, then you can legally derecognize the payable. Like, this just sounds like it's going to end up in court somewhere. So I think the IASB recognized the issues. I think where they're going to land is that when cash leaves the bank account, that's probably when it's appropriate for you to derecognize your trade payable, because they're like a trade settlement date. There's a trade date and settlement date provision of IFRS 9 that has to do with, I think, derivatives specifically, but I think using a similar concept. So I do think they need to amend IFRS 9 to kind of fix this issue. Like, it should have never gone to this. Like, we know how to do bank accounts. The standards shouldn't work against us.
Yeah, no kidding. So, I mean, just to recap your suggestion, which I fully agree on, to get a very good understanding and probably documentation of the current state would be the top recommendation for most companies, because realistically, it's probably a few departments, a few regions, and that project is a project. And so at minimum, put it on your list of potential projects to get a really good understanding and documentation of current state, because it would help your business anyways. And I would have to think that with this being raised at this international level, like where my head goes is due diligence. Like, the working capital component of a purchase price equation is always the one that ends up in court, as you mentioned. And now we're adding a bit of gray that arguably wasn't really considered gray, because we were all living with similar and equal assumptions. And now this is going to raise some questions if you have a purchase price equation with working capital unclear in the terms and conditions, right? So if you're looking at M&A and you don't have a current state documentation and understanding, I think you've got a hole that isn't worth having.
Yeah. So and that's what we found. And I was glad that we at least use clearing accounts. I was like, oh, that's helpful. Like, what's in that clearing account? Oh, it hasn't left our bank yet. Let's reverse that entry at the end of the month. It's a simple solution that
you have a population via the fact that you account for clearing accounts. But certainly there's a lot of medium and small businesses that don't account properly for clearing accounts.
You write a check.
More than a few big companies too. All right, let's figure out what's going on in 2024. Thank you.
Okay.
Oh, sorry, one last question. Is there nuances with cyber insurance? Anything to think about on that side, or would that, or would we?
Again, you're collecting, if you're issuing cyber insurance contracts, absolutely. If you're just purchasing cyber insurance contracts, that's just regular, just insurance. Yeah.
Awesome. Okay.
Also, and if you have your own captive insurance entities, if you're big enough like Nutrien, all of that is magically like eliminated on consolidation. So that's fun.
Awesome.
Okay, 2022. What are we doing here? Okay, two things. Very exciting as well. One of them is exciting. Actually, one of them's not in my mind. Okay, we have two amendments. The first amendment's IAS 1, and this was interesting because it was a little bit of a debacle from standard setting. I mean, this is the gossip in my world, so I'm going to share that gossip with you. The second amendment has to do with, it's a small issue, it's how to do with a lease liability in a sales and lease back. Both of these are January 1st, 2024 amendments. So the first of the two amendments to be adopted, so this amendment actually was supposed to be done in 2020, and the ISB set out to amend IAS 1 to address some classification issues between current and non-current liabilities. So to explain this issue, I'm just going to cut right to the chase that here is the actual amendment, but then I'll provide you a little bit of the gossip on the background towards this amendment. So in October of 2022, this year, a couple months ago, the ISB did issue a final amendment to IAS 1, and that's going to be effective for reporting periods beginning on or after January 1st, 2024. Early adoption is permitted. So what this particular amendment has to do is with debt covenants. So they call it conditions, it's debt covenants. What they're trying to do is actually get in and add some clarification into the gray area as to when covenants are or are not breached and when they have to be settled within 12 months after the reporting period to be classified either as current or non-current on the balance sheet. So the final amendment specifies that where the right to defer the settlement for at least 12 months is subject to an entity complying with a condition that's after the reporting period, those conditions do not affect whether the right to defer settlement exists at the end of the reporting period, and you can classify it for the purpose of classifying that liability as current. I'll get into example, those were a lot of words. However, as with all ISB amendments, there are going to be some additional disclosures now coming up for covenants, particularly if you are closer to breaching your covenants and there is a risk, you're going to have to add that additional risk language, letting your users know whether and how you expect to comply with those conditions after the reporting period. So here's how we got here and why I'm kind of laughing about this amendment. But the original amendment in IAS 1 was very wordy. And really what happened is that IAS 1 was amended to specify between current and non-current. Everyone had the chance to comment on this new standard. But then when the standard was finalized, it actually added an additional paragraph that didn't make any sense to anybody. And so the question was asked to IFRS saying, okay, looking at these 2020 amendments, we're going to get some really weird answers. Is this the spirit and intent of IAS 1? So I'll kind of walk you through on what the spirit is by the demonstrated example. So let's say you're company A, you have a financial year end date of September 30th. You have a covenant testing date and requirement to test covenants on December 31st after the reporting period. And your covenant is that you have to have a current ratio above 1. The actual ratio at September 30th is 0.9. So the position at September 30th, management's view is that, yeah, we understand it's 0.9 at September 30th. We have plans and perhaps our business is seasonal, blah, blah, blah. We expect to meet the covenant as at the testing date of December 31st. So what should be the classification in the September 30th financial statements? Well, under existing guidance, yeah, you haven't breached a covenant. The covenant's 0.9, but your testing date is December 31st from 3 months from now. If you breached on December 31st, that's when you have the issue, not now. Under the 2020 amendments, what they said was that if you had tested at September 30th, you would not comply with that covenant, and that is your testing date. So despite there not being a contractual breach of covenant, you could not prove that you will be in compliance with the future covenant within the 12 months, and therefore you have to classify your debt as current. So despite no contractual breach, you had to change your classification. I mean, that was just one problem, but that was the crux of the issues that were from these 2020 amendments. Didn't make sense to anyone, and it needed a correction. We didn't want to have to change all these practices. There would have been differences with US GAAP. So the ISB quickly revised standards and issued a new exposure draft that was released in October 2022. This issue has been corrected, and the resolution is just add additional risk disclosure. because under the 2022 amendments, you now can reclassify your debt as long-term. But if you are close, probably in this situation would require some additional disclosure to say, hey guys, we might be, we're not compliant today. Here's our path forward. And we're going to be able to meet our debt covenants. So something to be aware of for 2024. But it was a really good view to show, how standard setting works. That if you have issues, we raise them with IFRC. I know Nutrien raised a couple comment letters on this because we didn't want to see this issue going forward. So it was a really good outcome, kind of in our respect, that we were able to get kind of good standard setting before it was affected. But what you might see is when you're characterizing the amendments in the notes to your financial statements, that's why it will say we've adopted the 2020 and 2022 amendments. Because of course, the 2020 amendments didn't just have to do with covenants. They also had to do with classification between current and long-term when you have instruments that also have equity component in it. Not going to talk too much about it, but if you have convertible debentures or warrants or subsidiary exchange units, you might want to take a look at this and whether that would affect your classification between current and non-current. So in conclusion, the amendment just requires additional disclosure for most of us folks, which just have debt covenants in it. The last of the known changes and standards for 2024 is an amendment from IFRS 16, and this is liability in a sale and leaseback transaction. I also think this issue is cool because this issue originated with the IFRS discussion group in 2019. It's made its way through IFRC, then it made its way for standard setting through the ISB, and now we have a new standard amendment that we can adopt January 1st, 2024. So I think that's cool, but it only really deals with a very particular accounting, and that's a sale and leaseback transaction. So a sale and leaseback transaction is where you have an asset, you sell it for proceeds, but then you lease that asset back. Well, IFRS says, okay, well, if you're getting proceeds on an asset that you owned, and in substance, you're just leasing it back, you shouldn't be recognizing a gain up front. There should be some sort of deferral, complex tax or complex accounting, and a journal entry behind the scenes. Fine. That was all pretty well spelled out in IFRS 16 on how to calculate the ROU asset and the ROU liability. But the flaw was that what happens is if the lease payments are actually variable, it left to some wonky accounting. So all I'm going to say is if you're doing a sale and leaseback transaction and some component of the lease payment is going to be variable, read the new amendments. It's in paragraph 102A, and it just tells you how to account for that ROU asset and liability on day one, but effectively does say create a liability, don't recognize a gain or a loss, and don't do future modifications on that liability, just draw it down over time. So that is that amendment. A lot of effort to talk about. The last slide on amendments to IFRS from standard setters is I just want to spend some time talking about the future work plan. So we've kind of been in a standard, a low standard accounting between 2023 and 2024, not a lot of new stuff as I'm talking about, but here is the ISB work plan with helpful commentary by yours truly. So the first one to be aware of is the primary financial statement project. This is going to require a lot of time and effort to go through at a future technical accounting update. What the ISB is doing is they want to completely overhaul IAS 1. That's our basic how to present financial statements. That's your income statement, cash flow, balance sheet, statement of changes in equity, and your notes. Effectively, what they're trying to accomplish is to redo the income statement into 3 sections: operating, investing, and financing. And no, those categories will not align with your statement of cash flows. We're going to make it even more confusing. There's also going to be some required subtotals that you have to put in. I think there's a big push for companies to disclose some sort of EBIT number. So there's consistency across the globe on what earnings before financing and taxes look like. So they're trying to accomplish it through this primary financial statements. And also, much to the I don't know, happiness, surprise, I don't know. They're also trying to put in a management performance measure note. So now we're going to have our non-GAAP information, not only in our MD&A, but if you have a specific non-GAAP number that originates from the income statement, that's not EBIT, it's complex. Effectively, you're going to have a note in your financial statements about your management performance measures. So this is the original exposure draft was issued maybe 3 years ago, 2020. I think final comments were due. It was about 400 pages. There's a lot in there, but the ISB is really progressing through all of the comments that were received. They've been doing some roundtables. We participate in it. IDG has participated in some of the roundtables. So I am expecting to see either a revised exposure draft or a final standard coming up. And when that happens, we're going to have to spend a lot of time talking about it. So be prepared. That's going to be big. I don't think we're going to like all of the changes that come out and some of the required notes. So keep that on your radar. The next project, goodwill and impairment. There were two aspects of this project. I think it was a discussion paper that was released, but there were two spots. It said, hey, should we start amortizing goodwill? And B, should we have more disclosures on business combinations? Specifically, tell me all the information about your synergies and cash flows and sorts of confidential information. So recently, the ISB has concluded no amortization of goodwill. So they thought about it, US GAAP thought about it, ISB thought about it again. They've officially killed that idea yet again. So we are not going to have a reintroduction of goodwill amortization, and you're going to have to continue with the impairment models that we spend so much time completing over the end of the years. On the other side of things, they will ask you for a heck of a lot more disclosures on your business combination. So stay tuned for that one. The third one I want to mention, the project they're looking at, shouldn't be a big deal, but it is. Business combinations under common control. So I know most companies do a ton of business combinations or asset acquisitions under common control, even just to move assets through legal subsidiaries. How do we actually account for it? There's not a lot of guidance. So do you do book value method? Do you do asset acquisition method? The ISB would like to put a standard out there to tell us how we do it, as opposed to just letting us do it on our own and what's been working for the last umpteenth years. So it has the potential to have teeth, even though all of this will eliminate on consolidation, but just to make everyone aware of. The other 4 projects that are on the go, we've talked about supplier financing arrangements before. Do expect a final standard to be issued soon on that. That's going to require more disclosure. If you do use supplier financing arrangements, you're going to have to disclose more in the notes to the financial statements. The provisions ones, the ISB may issue a project on resolving discount rates. This will help resolve the ARO issue. Do you use a risk-free rate or do you use a credit-adjusted risk-free rate? Perhaps we'll get an answer on that. As I said, the IFRS 9, let's try to fix the derecognition problem. I think my comment, let's hope they resolve these issues before we have to relearn how to do bank reconciliations. And last but not least, the other project, the bigger one on the go, is called FICE. It's financial instruments with the characteristics of equity. Do you think we can resolve all the debates between whether an instrument is debt or equity? I doubt it. See, I told you, some marquee remarks to keep you guys engaged. We're at 12:52, still going strong, still have a lot to comment on, but let's get into recent IFRS discussion group topics. So as I said, the IDG meets 3 times a year, so I'm going to go through the May, September, and December meetings. Big shout out, if you're interested in this stuff, please do streamline it or read the meeting reports. I really do think that they're helpful. They're Canadian, they're helpful context for some of the things that we deal with in Canada towards IFRS. So there were 4 topics at the May meeting. Special purpose acquisition companies, or SPAC. This was that big structure in the US that they were trying to do to get these shell companies, and then they would acquire operating companies to get them to go public through backdoor channels. And then there was IPO questions, and the SEC was really hitting hard on those structures. But part of those structures, they actually had to complete an acquisition. I think it was in a year or 18 months. Regardless, now that these SPAC companies are starting to complete transactions, they're ending up with weird accounting, specifically on how to account for almost these reverse takeovers of a non-operating company. If any of this is sounding familiar, this was the same stuff that Canada dealt with our I think it was CPC transactions. That's the TSX structure, where you have a shell public company acquires an operating private company as a way to go public, and then securities law again had to step in to say, here's all the required financial statements that you need when doing these types of transactions. Anyways, all I'm going to say about that is it's ending up into some weird accounting if you're issuing warrants with those transactions. So if any of this applies to you, I would actually talk to your advisors, because you may have some retrospective issues coming from this IFRS decision. We also talked about financial reporting considerations for hybrid work arrangements, mainly if you're getting out of leases and when to derecognize leases, and do you have impairments? So might be a good one to peruse. We talked about IFRS 17 matters for non-insurance entities, which we've already chatted about. And one of the other discussions were share-based payment awards with variable vesting periods. So we considered a scenario where an entity was required to revise estimated vesting period of reward, but it was very specific awards that actually had to accelerate for a market condition. So blah, 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 that's a lot. If you have a weird share-based compensation with variable vesting, you might want to look at that. The topics for September meeting was actually in person, so there was a lot more. I'll just touch on the highlights, but we are going to discuss the first one in more detail, and that's the impact of rising inflation and interest rates on financial reporting. I think this is a great topic for all of us to think about, so we'll get into more detail. You'll also start to see from, technical accounting thought leadership, that the world, the OECD in particular, is trying to implement a global minimum tax of 15% on large multinational enterprises. Canada hasn't adopted it yet, but it's something to be aware of. And the ISB actually had to write, they're in the process of doing a new standard to how to account for the deferred taxes on that piece. So anyways, just something to know that these global rules are coming out. Google it. I think PwC has some good thought leadership on it if you think it matters to you. We talked about the IAS 12 updates that we covered. That's the deferred taxes piece. If you want more information, you can read the IDG discussion. We discussed about a subsidiary accounting for spin-off transactions, if you think that matters. Again, I'd go to the IDG. And then we also discussed at IDG this cash received by electronic settlement issue. The December meeting was shorter. I'm going to touch base on the first issue in more depth, and that's going to be the impact of climate risk on financial statements, an issue near and dear to my heart. And again, we also talked about the conclusion of the SPAC issue, and then Canada ceasing the CDOR rate and transitioning to the CORA rate. So if you're planning on applying hedge accounting using CORA, read that accounting paper. There might be some interesting things for you to consider there. Okay, so two last topics. This is going to be the impact of rising inflation and interest rates on financial reporting. So if anyone hasn't noticed lately, we are paying more in interest rates. They are through the roof to try to combat inflation. So one of the things I want you guys all to think about as you go through the end of your year is your WACC and your discount rate that you use for impairment testing. If you want a great example of a journey, Nutrien has had to deal with this issue, and you can go back and you can look at how we've disclosed this matter in our last annual report and then through the quarters. But these issues really arose in Q2 when our WACC started to increase and it really started to decrease the cushion. So we use a fair value less cost of disposal test. And when we have such a high discount rate, but the problem is that inflation, the long-term views of inflation aren't expected to grow. So when we're looking at our terminal growth rates on these models, we can't really apply higher terminal growth rates because we're not expecting inflation, these periods of inflation to last longer than 5 years. So we're in a situation where our terminal growth rate is pretty much the same, but we have these escalating costs in the near term. Not sure how much benefit we're getting, like the revenue piece is separate. But when you look at your discount rates have just increased. I think our I'm not going to, don't quote me on our discount rate. I think it's gone up 2%, but regardless, 2% on a fair value less cost to sell model, it is huge. And this is something that we're monitoring closely. We're constantly looking at our discount rates and how that impacts our impairment testing. So I think this is a serious issue that everyone needs to look at and reconsider how your WACC is built up, and then your cash flow models, and really looking closely at those cash flow assumptions. The other 3 issues are not as big in my mind. This does come from the IFRS discussion group topic, and the other ones were you might want to consider leases. So a rising interest rate might result in a higher incremental borrowing rate for the new leases. And also if you're doing some remeasurement, so don't forget about that. If you're calculating fair value, especially in your notes for your fair value of your debt agreements where you use discount rates, that's going to drive a difference in fair value. And then also provisions. So this actually might be a windfall with your ARO because your higher discount rate will lower your LARO provision in the current year. So things to be aware of for impacting rising inflation rates. And I think I have one more slide on this. Yes. 4 other areas that you might want to think about is your employee benefits calcs, your defined benefit pension, your defined benefit obligation, or your valuation of plan assets. How is a rising interest rate environment on your IFRS 9 calculation of expected credit losses, debt modifications? Are you doing modification in your financing right now for increases in interest rates? How is this going to impact those calculations? Consider that you have a new 10% test. And then just generally financial statement disclosures under the current IS1. There's always just a general disclosure requirement for sources of estimation uncertainty and changes in accounting estimates that might have a significant impact within 12 months. So just consider whether any of those apply as you're going through your year-end financial statements. And the last topic for technical accounting, I think if I know my slides correctly, this is the other IFRS discussion group topic that we spent some time in detail going about, and that's your impact of climate risks on financial statements. So in recent years, I think everyone's seeing stakeholders' demand for sustainability reporting really has risen. And in response to this, the IFRS Foundation has announced the creation of the International Sustainability Standards Board, the ISSB, and that's what we're going to talk about in the latter half of the presentation. With the ISSB standard, an entity is going to be required to include sustainability-related financial disclosures as part of its general purpose financial reporting. The ISSB hasn't said where. It can either be in a separate document outside the financial statements or inside your financial statements. I'm going to presume that in Canada, it will be separate reporting, just the way securities law is written. But time will tell is really how this is all going to evolve. But regardless, looking at current IFRS financial reporting, there is no explicit standard on climate-related matters. But climate risks and opportunities may actually impact several areas within your current financial statements. So while the immediate impact to the financial statements might not necessarily be quantitatively significant, I think more stakeholders are really expecting entities to explain even qualitatively how these climate-related matters are considered in preparing financial statements to the extent that they're material. So the IDG discussed a couple of these areas on how to consider climate-related risks and opportunities and how you should integrate this disclosure, especially when a company commits to net zero or other climate targets, establishes a climate strategy, including an overall transition plan. Really, the discussion was focused around the fact that there's a lot of judgments and measurement uncertainty in the financial statements, particularly in determining the asset's fair value, which may need to be considered as climate risks and opportunities in specific modeling. So, for example, do you need to start considering carbon pricing, current or future, in your fair value to DCF models? Do you need to start incorporating scenarios into valuations to determine more wider ranging outcomes? And do you need to build additional capital outlays to upgrade your assets to be less carbon intensive? And how do you build that into your discounted cash flow statement when you're doing an IAS 36 impairment analysis? Bigger question being, do you actually think a market participant would build that into a valuation model if you're under fair value less cost to sell? I think it's also important under IAS 16, that's your PP&E standard, to consider climate, especially with respect to your useful lives. Does your transition plan modify the useful lives of your assets if they're heavily into carbon producing assets? So if so, do you need to accelerate your depreciation expense? Another key area may be a provision, and I will put some caveats on this. So perhaps not now, but really keep in mind when you're setting your targets and your ability to meet your targets and commitments. Like, first of all, you might have the legislative requirement to change your ARO provision as regulations change, but you also want to carefully consider your public commitments regarding climate targets and transition plans and whether they create a constructive obligation. Now, there is caution. A statement or commitment now may not translate into provision today. You still have to have this past event to trigger it, but this is something you want to monitor closely. And also, if you think about it, if you're having a lot of commitments or if your cost to provide goods or services and they're sourced using greener materials, that might create an onerous contract if it's going to cost more, and now your contracts, your long-term contracts, may no longer be profitable in the long run. I think the key is that companies are at different stages in maturity in terms of their assessment of the impact of climate-related risks of financial statements. So these are all great areas to keep in mind. And really, if material, consider the disclosure obligations that you have now. I'm going to pause there before giving Canadian Securities Regulator update. Jamie, how are we doing?
Good. I know that we've got lots to cover, so I won't ask too many of the questions yet. But just a quick one in terms of that IAS 1 changing to have the similar categories as cash flow, but not actually the same as cash flow. Can you just expand a bit on that? And like in particular, is revenue going to be in 3 different sections?
No, good question. So the new standard will really outline what particularly is going to be a finance activity and what is an investing activity. I would say financing is the same as today. It's mainly your interest expense. I think they were going to try to play around with some of that. I think they were even contemplating like ARO interest expense to take it out of financing and putting in operating, but now I've just read that they're probably going to keep it in financing. So do expect like your interest expense to be the same. I think interest income might go up to investing, but your investing category is really going to be your investments on joint ventures and associates, but not aligned. Like when I look at the cash flow statement, our investing section is like our spend on capital assets and our business acquisitions. So that's not going to be aligned with the income statement. So think of your investing activities as your true investments and associates, equity investments, financial instruments, income that you're getting there. And operating section is going to be your default section. So it really should, we're now just going to have operating with a subtotal, investments, your operations after investing, and then operations after investing and financing. That's kind of how it's going to be set up. But our operations category is going to be that default category of where you put something on your income statement.
And that particular one is in the really early stages then?
They're doing roundtables and they're asking very specific questions on these roundtables.
Interesting.
I don't know if it was an exposure draft in 2020. You can read the exposure draft and there's some one of the things they even wanted to change was they wanted to, right now we present our income statement on a mixed basis instead of nature and function. They wanted to eliminate that choice. I've heard that they're bringing it back in. They also wanted to have an unusual income and expenses note in the financial statements. I've also heard they're not doing that anymore. So I think they're pulling back from the exposure draft to keep a lot of it a standard quo, which might mean they might not re-expose they might not re-expose. They might not need to, because it might not be as novel as changes proposed before, and they might not get any additional answers. But the ISB is going around and doing roundtables and asking questions, targeted questions about whether we like these things, whether we don't. So I do expect to see something. I didn't look at the work plan as to when they expect to release, but I would expect something maybe in the next year. We'll have a better update next year. I would expect it had to be 2025 transition at this point in time, but it might be one of the bigger projects that we actually have to put effort in terms of system reclassifications.
Yeah, I must be getting old because I feel like we just changed our income statement like a couple years ago. So it's probably
and we like added subtotals and IS1 was amended. It's like, oh, you can finally put
when we adopted IFRS. So and then quickly, the non-GAAP in a note. I presume that those numbers obviously have to be audited, and is that the driver for why it's, I mean, because the information is already really well disclosed and well discussed, but obviously there's the non-GAAP issue. So is that the driver to bring it into the financials as a note?
It is. So remember, IFRS is used globally. I think 136 countries, I'm making that number up, have IFRS. Most of those companies don't have securities regulations. We're in a lucky environment where we have Canadian securities regulators that require MD&As. Most companies in the world do not have any sort of management commentary that's required to be disclosed. So we're starting to, that's why IFRS, you always see advocacy for like these weird things to put in our notes. Remember when I was talking to my husband yesterday about this, the key management personnel note he's drafting. Right. And I'm like, yeah, most companies, like it's a stupid note, but most companies need it because we don't have Canadian securities law that talk about compensation. So people have lobbied over time to put that in the financial statements. Similar way, a lot of countries don't have non-GAAP rules. And so I think the international IFRS has been focused like, oh, we have all these non-GAAP measures, they're such a problem. And Canada's like, well, we kind of figured it out. But unfortunately, so now they want to have a note in the financial statements. I don't know if I like it or not, because it's really, we already have to disclose the same information. So we're just pulling it into the audit, but our auditor is going to question our whether our adjustments are reasonable and fair and reliable, like within the conceptual framework of IFRS. Like, does our auditors now have to opine whether we should or should not have included something? Whereas before, under Canadian securities law, you just make sure that the measure is useful and you've appropriately described the composition, but you just don't have that second set of eyes going like, really, are you sure? Like, is that management's best estimate of performance? There's going to be that added scrutiny. And I know some of the auditors have raised these concerns. On the other hand, that these performance measures are only income statement based measures, which in our environment where we have oil and gas and it's mainly like funds flow, that wouldn't have even been captured in the notes. So I think I think when I looked at Nutrien, for example, only our adjusted EBITDA, like out of all of our non-GAAP measures, only our adjusted EBITDA would comply, would have to be put into that note. So it's not a huge deal. And maybe just from a page count issue, we're like, oh, there's less pages in our MD&A. Put it in the note. So I don't know.
Yeah. Well, no, that's a light bulb for me. I never even thought of that when we see the duplication and the discussion and the efforts and the standards that Canadian securities gives us, that that there would be that many countries that don't have that level of extra clarity, I guess. So that's a really good point. I never thought of that, but I won't hold you up anymore because we have a lot to get through and we're really getting tight on time.
We are not. I'll make it work. I never track these. I was like, I'll just talk until I stop talking. Really kick me out of these things. Okay, Canadian securities regulatory update. So we have the proposed 51107 climate related disclosures. That's the ESG one. Talk about that next. It is delayed. Shocking. So the only other amendment that I had was 51102. We spoke about this last year. This is the project where the Canadian Securities Administrators would like to combine the MD&A and AIF into one document with the annual financial statements. Comments were due September 17th, 2021. We haven't heard anything since. I do think one of the comments that Nutrien raised in relation to this was, how is this going to work with the future of integrated reporting? Does the AIF really fit with the MD&A? Like, do we really want to go the 10K approach and have a really long document? So I do think the CSA is carefully considering those comments, hopefully. Okay, well, we already had a question break, so no more questions. Let's get into my favorite topic now, and that is ESG. I don't know if it's really my favorite topic, but I can tell you hedge accounting is not my favorite topic. So I'd rather talk about ESG any days. Okay, this is actually a slide from last year because I kind of wanted to give a sense of like where we were last year to where we are this year. Because last year was really when we started to see the movement of ESG take shape. So last year we had a bunch of voluntary reporting frameworks. We talked a little bit about TCFD. You had a value reporting foundation, and that was the merger between SASB and this integrated reporting council. You had this international business accountable statement. You just had a lot of things. You also had rating agencies like CDP and like Morgan Stanley's like international index and blah, blah, blah. You had a lot of stuff asking for a lot of information. And that's why you see these super large ESG reports that you do see today, because, and Nutrien's also included, because we comply with all of these voluntary frameworks and rating agencies, but they all ask for slightly different information. And so we're trying to have a one-size-fits-all approach through these ESG reports to comply with CDP and all of their required, or the SASB metrics. And it's just kind of expanded. And I think from a preparer's perspective, we're a bit exhausted with the amount of information that's being required, but might not necessarily be material for all of our stakeholders. So there really is becoming a push through mandatory reporting requirements, first of all, to just scale it back to only disclose what's material to your business and really have a global baseline in standards. So we really are quickly shifting to a world where there's just tremendous global efforts towards mandatory regulatory reporting from both public and private companies alike. So I mean, this shift is so substantial that Nutrien's now set up an ESG compliance team, which I'm leading, to kind of help us get ready for some of these mandatory disclosure requirements. So I just wanted to spend some time today to level set as to what's coming, so you can start to see how big that this could possibly be and where we're at in the standard setting process. So from a reporting standard perspective, the ISSB was formed back November 2021. It's quickly taken shape. Following suit, we've also seen the creation of the Canadian Sustainability Standards Board. They're just doing a call out for board member positions. Anyone interested? Call them up. I would expect we're going to see a very similar environment that we do with IFRS. So we have the International Accounting Standards Board, here's my screen, and then we have the Canadian Accounting Standards Board that helps set those standards to which we implement. But we implement it because Canadian securities law tells us to use IFRS as for a public company. And it would also say then Accounting Standards Board would set private company accounting standards. I think that's the path that's trying to be formulated with the CSSB. We're going to have the international board, the Canadian board, which will be a taker of those standards. And then we'll see some sort of scalability, hopefully, for nonprofits, our private entities, on how to adapt these sustainability standards at each of the different kind of levels of organizations that we have in Canada. But really, the ISSB for public companies can really only be effective if they're regulated into securities law, at least from the public company standpoint. So if we look at the regulatory requirements, we have the three large regulators that have also come out with their own standards. So from the securities regulator perspective, we have the Canadian Securities Administrators proposal. That was first off the docket. That was National Instrument 51107. That was issued in October 2021. Then in the spring of 2022, the SEC issued their 490 pages, their long proposal called the Enhancement of Standardization of Climate-Related Disclosures for Investors. And not to be outdone, you have the Corporate Sustainability Reporting Directive, and that's coming out of Europe. And we'll get into more detail now. But before we kind of get into the rules, I wanted to just level set on, I love that word, on what is the base of these securities regulation, because they are effectively becoming a global baseline, but there are nuances to know about, but they all are asking for around the same things. So I want to just say what those are based on, and that's the TCFD and the GHG protocol. So the first one is this task force on climate-related financial disclosures. And I swear to God, I call it TCFD all the time. I still have to Google, like, is it task force? Like, what does TCFD stand for again? But this is the baseline for the securities standards and regulations. Since it was finalized in 2017, the TCFD framework has really been widely accepted by issuers, investors, and other market participants. And it is this base framework for what you're going to discuss and how you're going to discuss climate. It's pretty easy to read. It's 74 pages. It's free online. You can get the gist in the first 19 pages. So I strongly recommend just reading the first 19 pages of TCFD to start really getting a sense of what it's about. But the core elements that are in the TCFD are listed on the slide, and it's not rocket science what they're asking. It's kind of how you consider climate as a company with these 4 core pillars of governance, strategy, risk management, and targets. So you know how to set governance for the organization. What's the strategy behind climate risks and opportunities? How are you managing those risks, and how are they embedded in your ERM projects? Have you done a scenario analysis to really flesh out what are your risks over the next 5, 10, 30, 50 years? And then at the end of the day, how have you thought about that holistically in terms of your strategy, and then set targets on how you get there? And when you set a target, what are your metrics? So it's a pretty straightforward standard, and that's what we're starting to get, that people want to know, like, how are you considering climate risks and opportunities in your financial statements? But the one thing that everyone has pretty much agreed on at this time is, okay, well, what is a key metric that we should use to start evaluating climate? And I think we all are aware now, carbon is probably, like, how much carbon and carbon intensity, that's pretty much driving climate change on our world. So how about we start measuring carbon and our carbon footprints? And how do we do that? You do that through the GHG protocol. So that was kind of the first standard, and it's pretty widely accepted and is going to be a baseline for reporting. As to your GHG footprint, it was really, it covers the 7 greenhouse gases that were in the Kyoto Protocol: carbon dioxide, methane, nitrous oxide, other GHGs that I cannot pronounce. But also what this did was introduce scopes of GHGs and emissions. And this is another place, besides reading the TCFD, if you're going to start your ESG journey, it's just starting to get a handle on what are your sources of emissions, and at least starting to calculate your scope 1 and scope 2. So scope 1 being your direct emissions from the production of your products. Scope 2 is your purchased electricity, heating or cooling that you kind of brought in. So think your electricity and utilities invoices. And then scope 3 is a beast, and it's everything else. There's 15 categories of scope 3. Not all are relevant to each organization, but it's like, what are your emissions from your purchased goods? What are your emissions from your capital goods? What are your emissions from your used products? So for Nutrien, you apply fertilizer on the ground, and then through volatilization of nitrogen fertilizer, effectively, if you apply too much, it gets absorbed into the atmosphere, and that is a carbon, that is nitrous oxide, which is 300 times better at trapping trapping heat than carbon dioxide. So that's something we care about. But calculating this is going to be a baseline requirement of these securities regulations. So what have the rules proposed? On a high level, the Canadian rule was the first one out. It is scaled back compared to the other rules, I think being the first one out. But what they did say was that the Canadian Securities Administrators in October of 2022 did say, like, hey guys, we did see that the international standards are out and the SEC standards are out. We're going to see what those standards have and how we're going to embed it. So I think there's a delay on Canada, and it might move towards more alignment with the SEC, but here's what originally Canada proposed. So first, it required TCFD disclosure, governance, risk management, strategy, metrics, and targets. It was to be included in your AIF or your MD&A if you don't have an AIF. Disclose scope 1, scope 2, and scope 3 emissions, but there was an out. It was done on a comply or explain basis. So this is the same as the Women on Boards disclosure. Discuss your targets and performance against those targets where material, and it did not require scenario analysis. So it really is a lighter touch on starting to adopt this. So we'll see what part of these standards stick. and whether they're going to have to repropose the rule if there's going to be additional material requirements included in the final proposals. The other big one I'll spend some time, which is probably why Nutrien is looking towards, and we stood up a compliance team because the SEC is just asking for a whole lot in their 490 pages. The SEC's disclosures are more. They're asking for 2 types of disclosures. First, the climate-related disclosures in your MD&A, that's your TCFD stuff. And then they've also proposed financial statement metrics in the audited financial statements. And this SEC has written a rule that requires a lot more deep requirements and more detailed requirements than the TCFD. So like from a governance standpoint, they're actually saying, name the board member who has direct expertise and what is their expertise and how did they acquire it? So it's very detailed information that the SEC is asking, but it is framed in governance, risk management, strategy metrics. They're also asking for scope 1 and scope 2, but actually to be reasonably audited with reasonable assurance, which is huge. So they're now asking for assurance on scope 1 and scope 2 by each of the 7 greenhouse gas. They're going to do scope 3, but no assurance required, thank God. Disclosure of zip code locations where you have physical risk, disclosure of scenario analysis if used, disclosure of an internal carbon pricing if used, and then more worrisome is these climate-related metrics within the audited financial statements. So effectively, the SEC is trying to implement GAP. That's a lot that they're asking for, and we're not even sure how it's going to relate to IFRS financial statements. I will say with the SEC, the initial proposal has scoped out MJDS issuers, so our Canadian issuers, and using the cross-jurisdictional securities law that we have in place. But we're not sure that whether the financial statement note would also be included in that MJDS scope out. So the SEC is something to be concerned about and to look carefully when they propose their disclosures. This is my last slide. Everyone's like, oh God, please make her stop talking. But just to give you a sense on just when the timelines have evolved. So again, we have the ISSB. Do expect final ISSB standards. They've issued 2. They've issued the general standard, and they've issued their climate-related disclosure standard. Again, TCFD, scope 1, scope 2, scope 3, scenario analysis. And not only do they want to talk about climate, but also general sustainability issues. So water, biodiversity, human capital. If it's a material topic, they want you to disclose. Expect final standard for IFRS S1 or IFRS sustainability standards S1 and S2 being available for adoption early 2023. However, for Canada, date is unknown whether how we're going to adopt those. The CSA rule, it was published. We expected it to be delayed from the original Q4 2022. So the date is going to be unknown for TSX filers, and then venture filers will have a delayed adoption period after the TSX filers go. The US SEC rule originally was supposed to be out. US SEC rule was supposed to be published here. We're expecting to see something spring 2023. But so expect them not to be effective till 2025, probably for fiscal year end 2024. And then the EU is a sleeper issue as well. If you have European operations, I'm talking about over 150 million in revenue, over 40 million in assets, and I think 250 employees, you may be scoped in. So despite not having a listing in Europe, you may be scoped in for 2029 reporting, which is interesting. We're hoping that they'll combine with the ISSB and SEC towards that time, but don't lose sight of EFRAG if you have European operations like Nutrien does. So that was a lot today. That was fun. That's all I have for you guys. I'll pause for questions in a second, but my appendix at the end, I just had all the IFRAG agenda decisions, and then just how to search for past discussion group meetings and IFRAG agenda decisions. I left it there, but that is all. Do I have a thank you slide? I do have a thank you slide. Jamie, 2 minutes to wrap up. Or question.
Awesome. No, that is a lot. I think one thing's for sure, accountants know how to keep themselves employed with changes and advancements and new things all the time. So a lot to absorb, and obviously some of it more applicable to certain people and other parts more applicable to other people. So that is an awesome overview. And obviously, as Janice mentioned, you'll want to get into a deeper dive for those things that are likely to be applicable to your business and your role. Quick question on ESG before we wrap up. The one thing that's interesting is obviously that scope 3, and how, I guess just want to hear a little bit about what's happening and what your perspective is. You said there's about 15 specifics listed, and so how all encompassing is that? For example, if you don't have a product and you're a service, does that get looped in somehow? Like, I kind of have the impression that sure, it's 15, but at the end of the day, everyone's gonna fit there somewhere, which leads me to the next question of, how is it going to be possible for some small medium business to serve big public companies when the practicality and the cost is just going to make it not worth their time and effort? And what's that going to do to our economy and what we're really trying to achieve as a community and as employers, and trying to make the better world that we're trying to achieve?
Well, I thought as accountants, we're actually trying to make more money out of this. So I think we're going to be in for a long time. So there's 14. So I think if you're a service company, you probably have less emissions than, let's say, Nutrien. You might fall under employee business commuting is a category. How much emissions are your employees using as they commute to work? Like, are you kidding me? That's the emissions they want to know. So what are you driving? How long does it take? How should you compute it? Employee travel. So are you tracking, have you actually noticed on your airline tickets, some of them like Air Canada have, here's your emissions. So that's the information that they want you to collect and report on. So I think you will find a category for every company. I agree, if you are doing a manufactured goods, your upstream and downstream value chain, it is just going to be huge. We've engaged PwC to help us out with calculating and even coming up with our baseline scope 3. That project, I'm a part of the project team, and it's just astronomical to even think about some of the calculations we're doing, and the data is just not there. Like, I do think we're going to be in a world where suppliers might put on their invoices like, oh, here's your emissions. We're far from that world despite securities reg. In terms of thinking about it as a private company, you might have to start thinking about it. The one thing to know, at least with the SEC rule, is that financial institutions, if you're reporting to the SEC, are captured in the rule. And if you issue debt or equity to a company, their emissions become part of the bank's scope 3. So I do think under current rules proposed, the future will be even the private companies knowing what scope 3, it's going to be just part of doing business. Whether you start on the scope 3 project now, probably not, but I'd start doing your scope 1 and scope 2 to understand what your footprint is. And
and I think it's important to note that, right, that these things apply to all of us, whether it be because investors, bankers, stakeholders that can be activists about expectations and result in relation to this, or your customers when it comes to scope 3 at a minimum, if not earlier in the cycle. So it really is applicable to everyone, and obviously CPAs and business leaders are going to be instrumental to this journey. So it's a lot, and it's better to start early. So I think it's important for everyone to realize that if you're tuning out at the end, read the video, because you're not applicable, even if you thought maybe you weren't. So I think that's an important thing. And the video is available to revisit all these topics. And as you mentioned, Janice, certainly all AHA members will get the slides as well. So with that, we're over time. Just a quick recap again, February 2nd is almost sold out. If you want to do a live networking event that's targeted towards growth businesses and business owners, please do come and join Good Lawyer, ATB, and Alberta IoT, and we're going to have a panel. I'm excited because I'm a panelist, not a facilitator, so that'll be exciting. February 3rd, Tuesday, we're doing a webinar on cybersecurity, very important topic. March is going to be in tax. April is going to be insurance, also the 3rd Tuesday. And another exciting news, we are also going to be launching anchor content in a YouTube video form and podcast form, and that's going to be called Let's with Amplify, so lively entrepreneurial talks. And we are excited. We're doing our first video on Thursday, and it should be out within the next month. So there's no shortage of content and information as we try to live our purpose here at Amplify, which is supporting our network, which is all of you, CPAs and business leaders that help us out and help us help small and medium businesses that are growing. Thanks, Janice. And we'll see you at FEI soon. I'm excited that you're coming to visit. Anyone else that's interested in FEI? I am the membership chair, so I really need members, and it's a very fun and awesome information opportunity. So that's another chance for networking and learning. Thanks, guys. Have a great day.
Thank you. Bye.